Welcome to the Steps to Investing podcast, helping aspiring investors get to grips with the world of finance and investing. This week we look at ESG, or environmental, social and governance style investing. It's an investment that lets you invest in line with your values and beliefs so you can sleep soundly at night, but at the same time expect a decent return. Hello, I'm Simon Longfellow.
And I'm Marcus De Silva.
And welcome along to this week's podcast. How's your week been this week, Marcus?
Yeah, good, thanks. I think probably one of the interesting stories I picked up this week was one from the FT, and it was talking about the pressure that the city seems to be under to embrace SPACs, as they're known, special purpose acquisition companies, or blank check companies in the more common vernacular. And that's because in this sort of post-Brexit world, and the increasing competition we're seeing, particularly from places like Amsterdam, which has been stealing trading in derivatives and shares, we need to find a new niche that we're kind of good at. And this SPAC revolution, it's been going on for about a year, began in the US, where there's been quite a lot of listings. And basically what it is this empty shell of a company. It's got no operations, run usually by some sort of private equity kind of guys, is listed onto a stock market empty, and then with the promise that it will find a private company to acquire so that that private company effectively becomes listed onto a stock market. And it says that it will do it in, let's say, a certain amount of time, say 2 years. So you've obviously got to have a lot of belief in who that investor is, that they will be able to go and find a good company that's worth listing onto the public stock markets for the first time. And why would a private company like this? Why do investors like this? Well, it massively reduces the friction of listing for companies. I mean, when that happens, when you decide to go public, it's quite disruptive to the business. It can be very costly. It takes quite a lot of time, and it can fail at the end of it as well. So this reduces a lot of those issues and just gets these private companies listed quite quickly. So they're a new thing, and people are pretty excited about them. So what this article is saying is, we should become a bit of a hub for that. I think for the private investor, those is pretty sophisticated because they're private equity-like. They're quite risky, so you've got to be quite aware, I think, if you wanted to get involved in any of these. They're all focused in the US at the moment. But it'll be interesting to see if the UK, does end up being this hub, really. It certainly bodes well for having new public listings, having an increase in the amount of public equity out there, because actually what we've been seeing over decades now is a bit of a dwindling of public markets. So this could reverse that trend. So I thought that was quite interesting. And do you know what? We'll have a look at SPACs in a bit more detail, probably in a podcast a little bit down the line. How about you, Simon?
Well, speaking of which, I was just going to say thank you to those people who got in touch after last week's podcast when we asked for ideas for future shows. We've had a few. We'll be looking at those and fitting them into the schedule as and when we can. So thank you for that. If you didn't get a chance to put pen to paper, then you can email me at simon@stepstoinvesting.com. If you've got a burning question or just a topic that you want us to cover, we'll look to do that in the future. Okay, so today's pod we're going to talk about environmental, social and governance style investing. Before we do that, let's catch up on what's been happening in the world. Marcus, how have markets been this week?
Yeah, well, I think they are continuing to be quite bullish, quite positive amid the success of vaccine rollouts and also the promise of Biden's big fiscal stimulus package. Also, Fed Chair Jerome Powell has been boosting the mood as he's reiterated that a focus on the economy would supersede any near-term inflation that they might see coming through in the system. So that means lower rates for longer, really. So that, what this is creating, what we're in the midst of is the reflation trade. So we're seeing government bonds continue to sell off and stocks continue to rise. And when we say reflation trade, we're talking about the rotation into assets that benefit from higher growth and inflation. Remember, the reflation trade is made up of both of these things. As I know, it sounds very similar to inflation, but it is actually both inflation and growth that is creating this trading. So attractive assets in this environment include more cyclical stocks, anything that's geared to economic growth. So we're talking about sectors such as banking or energy. It also means smaller companies over larger size ones. They're a bit more attractive. And it also means emerging markets are a bit more attractive in this environment as well. And I think commodities are another classic part of the reflation trade. We've seen oil at 13-month highs, copper at 10-year highs, and currencies linked to any commodity producing nation looking pretty strong too. Where it takes capital from the reflation trade is safe haven bonds and any company shares that are sensitive to interest rate rises. So this includes things like real estate investment trust, REITs, sectors like utilities, and also tech. Certain tech stocks are a bit sensitive at interest rate rises, as it reduces the value that investors place on it in the present day. All in all, the S&P 500 is up 9 points to 3,925. The FTSE 100 is up 73 points to 6,691. The Stock 600 is up just 1 point to 414. And the Nikkei 225 is slightly down 141 points to 30,168. Simon, how's company?
Well, more news on shares in embattled US chain store GameStop this week. Prices of the shares went up again, causing trading to be halted twice, in fact. And on Wednesday afternoon, the shares doubled in value. And in fact, they were up 104% just before the market closed, and went on to gain 90% in after-hours trading. At the same time, the online chat platform Reddit inexplicably just stopped working, crashed, leaving many users unable to access their accounts. Now, Keith Gill, who's been called the leader, really, of the retail investor movement, which bought shares to increase the price of GameStop, thus causing all of these losses for hedge funds who'd been betting on its share price falling, he's now the subject of a lawsuit. He allegedly has duped retail investors into buying inflated shares, price-inflated shares, whilst hiding his sophisticated financial background. That one will run, I think. Moving on, Oatly, the plant-based milk company, which was started in Sweden, is planning a stock exchange listing, just what we've been talking about, but this one's going to be in the United States. The move comes as the firm has been pushing to expand because of the increased popularity of these alternative milk-style drinks. Last year, it raised about £160 million, with investment coming partly from celebrities like Jay-Z, Oprah Winfrey, and Natalie Portman. The firm, which sells its milk in more than 20 countries, didn't say how much it hoped to raise in the listing. Finally, car brand Vauxhall is set to decide on the future of its remaining UK factory in Ellesmere Port. It employs about 1,000 people directly, and of course many more in the supply chain. The announcement on whether to close the plant is due this week, and Stellantis, which is Vauxhall's owner, has met with government officials to discuss options. The factory, its problem really is that it produces diesel and petrol cars, which will be obsolete in 9 years' time, 2030, when the UK government bans the sale of fossil fuel-powered cars. So, moving from fossil fuel-powered cars to ESG, why are we talking about this, Marcus?
Well, as I mentioned in our podcast a few weeks ago, it's the hot investment trend at the moment. It seems a lot of commentators are talking about it. A lot of investors are wanting to buy it. And some are even saying this could be the saviour of actively managed funds, given their poor performance, really, over the long run. We'll have to see how, indeed, ESG performs over the long run to see if that holds up. Last year was seminal for this trend, really. It seemed as if responsible investing finally moved into the mainstream as the assets that were attracted to these types of funds broke records. So if we look to the industry body, the Investment Association, in the UK, net flows into retail funds, so that means net new money, considering the outflows as well to the funds, in the retail space, the U&I space, trebled from 3.2 billion of net flows in 2019 to 10 billion of fresh capital in 2020. So it was a big uplift there. There are three areas really in responsible investing. You've got sustainable and responsible investing, SRI, which is really negative screening. It's not wanting bad companies like firearms and tobacco. There's impact investing, which is this very razor-focused subset that we were talking to Ben about a few weeks ago. And that's finding companies who have operations that are actively engaged in sustainability issues like clean tech, etc. And then the largest is ESG investing. And that's funds that use company ESG metrics in order to analyze investments and make investments.
Okay, so let's take a step back then. Just explain to us what ESG investing actually is.
Yes, so ESG is a framework for fund managers to look at the softer parts of a business. So it's separate from its financials, the balance sheet stuff. The framework looks at three key areas: the environmental, the social, and the governance side of businesses, in order to assess if a business's approach in these areas creates investment risk and therefore it affects the fundamentals. That's the business case for why it should succeed and perform strongly in the future. So on the environmental side, the obvious criteria might include energy uses or waste management or pollution. So you may be asking whether a business's emissions could lead to reputational damage or could be reduced to increase operational efficiency. On the social side of things, you're looking at our business's human relationships across employees, customers, consumers, suppliers, anyone in the stakeholder chain. And you might ask how extensively a learning and development program is rolled out for employees and therefore might be able to improve performance, or whether decision making in the business could be improved by promoting diversity across the workforce. On the governance side of things, it's how the upper echelons of management are structured to ensure good performance and decision making. So it could be how independent the board really is, or whether shareholders are properly represented. Whether an opaque remuneration structure could be hiding dodgy payments, that kind of thing.
Okay, I get all of that, and it all sounds, very worthy. But how is that supposed to help investors? How's that supposed to produce superior returns?
In short, fewer investment risks, higher likelihood of quality management, good performance, and strong returns. So if you don't care about this stuff, the management can't be that great, really. If you abuse your stakeholders across the chain that are critical to success, then why would you be around for that long, really? It is the indicator, really, of the quality of a business and its management, of long-term strategic thinking, of holistic care of the entire stakeholder chain that's so important to your business, and therefore the likelihood to perform strongly. So, in theory, this should produce better returns.
Okay, I guess I sort of understand that quality companies, good returns, but how does it all sort of translate?
Well, it hasn't been around for that long as an investment approach, so we still need probably some longer run figures to really assess this properly. But so far, so good. Fidelity, a large US asset manager, releases a report putting sustainability to the test. And this kind of serves a point, really. They had a list of stocks of varying ESG quality, so really high quality ESG companies and to lower ones. And in 2020, the stocks with higher ESG ratings outperformed those with lower ratings in almost every month. So that was quite interesting. Also, I saw a chart from TrustNet, which is the data provider, and that showed that in the 3 years to February this year, its global ESG-focused index outperformed the broader global index by 2 percentage points. So that's, it's good news so far.
Okay. And what about the pandemic, or pandemonium, as I like to call it? How has that accelerated this trend towards ESG with, ordinary everyday investors like ourselves?
Well, it's tipped the balance because the framework looks for the exact issues that we've all become aware of and even experienced during the pandemic. It just sort of coincides. So the environment to us seems so much more precious today, as day after day we're sort of locked in these brick boxes. And people, they actually can see the effect of economic activity on climate change. We've noticed bluer skies. They're just much more aware of these issues. Inequality issues as well has been another one of the past year. And people are now more aware of the fact that that gender, sex, racial inequality issues can evidently translate into the workplace. So you had people who were already impassioned by resolving these existential issues have been encouraged further, and you've had those on the sidelines, I think, now taking part. So there's just been this jolt into getting more people interested in this kind of thing. Also, seeing Biden come back to power will have an effect too, as this has pushed climate action back up the global agenda. We saw people like Richard Curtis as well launch a campaign on investing sustainably in your pension, as this idea catches on that the collective use of our wealth amongst private investors can throw real weight behind some of these issues. Case in point is millennial investors. They're becoming increasingly wealthy. Remember that over the next 10 years, 10 trillion will pass into their hands. And they're very interested by ESG. According to a study by Morgan Stanley, 95% of them are interested in ESG type investments.
Okay, so all positive. There's got to be a downside somewhere, surely. What are the risks involved?
Yes, and I think absolutely right. You've got to look to the risks. The first, I think the big ones are, the first is greenwashing. Companies could present themselves as far more ESG-able than they actually are. But increasingly, we're seeing more reliable and standardized data across ESG metrics that should resolve this and also enable the development of better passive investment products in this area, which would use that sort of data in order to decide how the investments are made. The other is a bit of a skew towards the quality factors of a business that have been very popular. Those types of companies with high quality scores have done really well over the past decade, but in particularly over the past year. So these ESG type businesses might be doing well on a bit of a basis of trading on that. And that could come undone as the economy recovers and investors opt for more value type economically linked companies that are outside of the ESG sphere that are better geared to global growth. But that said, I think that feels fairly short term. In the longer term, I think, which is where you want to base your investment cases, I think this still looks pretty attractive from that point of view. Okay, so Simon, what have we got in terms of some ESG investments?
So if you wanted to start with some investments in your portfolio that were ESG friendly, how would you go about it? Well, as ever, we'll take a look across the three major investment structures. So investment funds, investment trusts, and exchange traded funds or ETFs. I won't cover it in detail here in terms of those different structures and what the differences are. But if you want to learn more about them, then a very good place for you to start would be our 7-day course. You can sign up at stepstoinvesting.com and it'll get into all of that detail. But let's take investment trusts first. Very helpfully, the Association of Investment Companies, which is the industry body, has created some groupings, or sectors as they're called, for exactly this. The first of which is very helpfully named the environmental sector. Now, at present, there are only 3 investment trusts in this sector, and they're the Impacts Environmental Markets, Jupiter Green, and Menharden Investment Trusts. But they also have another sector of interest here, which is the renewable energy infrastructure sector. That's hard to say, with 17 investment trusts to choose from in that sector. But, and it is a big but, and you've alluded to it already, one of the issues is that this is such a new phenomenon that the track records of these investments aren't very long. So of that 17 in the renewable energy infrastructure sector, actually only 6 of them have got 5-year performance histories. So one of the best performing of those that have done 5 years is Bluefield Solar Income. Now, if you'd invested £100 in that 5 years ago, your £100 would now be worth £192.10. What does it do? Well, in its own words, it's to provide shareholders with an attractive return, principally in the form of quarterly income distributions and the payment of a dividend. And it does that by being invested mainly in solar energy assets in the UK. So it has this income focus. At the moment, in the last year, it's paid 8 pence in income. That's known as a dividend. And over the last year, as I should say, at the moment, the share price at the moment is 133 pence. So if you divide one by the other, you get something called the yield, which in round numbers is about 6% at the moment.
Okay, so that's an investment trust. What about an open-ended fund?
Yeah, let's have a look at an investment fund now as an alternative to an investment trust. Now, unfortunately, the Investment Association, which is the industry body for funds, doesn't have the same sectors as the AIC, and in fact, it hasn't got sectors at all for ESG type investments. But the internet has come to the answer. Quick trawl tells me the main firms focusing on ESG, and the names that pop up are some of those big fund management houses like BMO, Martin Currie, Fidelity that you might expect to hear. I also found, though, that the data platform Morningstar has invented a sustainability rating to complement the other ratings that it has. Sounds good news. Closer inspection, it's not a rating, though, on how sustainable the fund's investments are, but just whether they use ESG type words in their stated investment objectives, just to give you a sense of a list of funds that might be helpful. So I had to trawl through the list. One that sprung out was the BMO Responsible Global Equity Fund. It rates quite highly on the Morningstar list. The fund objective is to provide long-term capital growth, so growing in the value of your money. And it seeks to do that by investing in companies around the world, but screened against some of the things you were talking about a moment ago, the defined responsible and sustainable criteria. So that includes exclusions on tobacco, alcohol, weapons, gambling, the nuclear industry, and pornography. So taking that logic, its top 10 holdings include companies, you'll have heard of them: Apple, Microsoft, MasterCard, those kinds of people. If you put £100 in the fund 5 years ago, it would now be worth £222 in round numbers.
Okay, so those are the sort of actively managed kind of space. Both have a fund manager making the decisions about what's in them. But what about a passive fund where investments are determined by tracking just a defined group of companies?
Yeah, that's right. Those two are active. Let's look at a passive style fund. Now, Vanguard are one of the big players in this space, and they offer actually two kinds of passive funds. Those listed on a stock exchange, they're known as an ETF, as I mentioned, an exchange traded fund, or those that are not listed, they're just simply passive funds. Now, the one I've chosen to take a look at is the Vanguard ESG Emerging Markets Index Fund. It's a passive fund, as I say, not an ETF. It tracks an index made up of companies of all sizes in what we call emerging markets. So countries like China, Taiwan, Hong Kong, India, Brazil. And in fact, there are over 2,500 companies in that index, and therefore in the portfolio of this fund. Now, the biggest holdings in the portfolio include names like Taiwan Semiconductor, Tencent, and Alibaba. The fund was only launched pretty recently, actually, in July 2020, so there's no data I can give you on how it has performed, but I can tell you that the charges are pretty low at 0.25% a year.
Well, that is pretty low. Okay, well, just as a reminder to anyone, none of these are recommendations. We don't know anything about your personal circumstances. These are just some examples in order to get your investing juices going a little bit and give you some ideas.
Super. Okay, well, that's it for this week. Next week, we talk to a real live investor who just made his first investment in the last few weeks. So we're chatting to him about his journey and how he's been getting on. Join us again then, but for now, goodbye.
Goodbye.